Oh, look. And I said, there's no flamingos in Orlando.
No, absolutely not. Look out for peacock. They're everywhere.
Now, shook up. I know when you get older, you just can't keep things down.
So
You get afraid it might trigger a heart attack or something.
Yeah, something, something.
this weekend we went to the Busch Gardens.
Yeah.
To the girls. We have two
Yeah.
daughters, and so they have the new ride. What is it? The
Iron Gwazi.
Oh, Wazi, yeah.
So my youngest made me promise to go on there. Because I'm like you.
Yeah.
I used to go on them, but
Yeah.
now that was intense.
You got off that thing, I think I need a Sprite or
I'm
something.
not doing
Nothing else.
no.
Yeah.
And you sure didn't either.
Nope.
Yeah, you done. You had to try to keep the school. I'm good. Everything was. I need to go to the bathroom. I'm good.
What was that roller coaster we rode
In
at Busch
Virginia?
Gardens in Virginia?
I know.
It
I'm
was
trying to think of something like.
Veloster.
Yeah,
something like that.
Something like.
It goes forward, it
And
takes
it takes
off,
you backwards.
and you do a loop. And then we thought, okay,
We're done.
we're done. It comes back to go straight. No, it looped again, and then we went backwards all over. We were done.
So we both were like, she was purple and green, and I came off like, I think I have to go to the restroom. And it was awful. I mean, it took time. She was just done. We had to leave the park, and I had to drive home. I was like, Lord help. Hey. There we go. It's Betancourt. She made it.
It's funny.
All right.
Okay, meeting can commence.
Exactly.
Daniel Betancourt is on Zoom and Michael Maldonado is supposed to be on Zoom.
My ex-wife, she was there also, and I took my daughter to Busch Gardens. We looked at her and she had like, and she was like, you want to ride it? She's like, you don't have to ride it. I'm like, we just stayed in line for like an hour. And I'm like, just come here, you can still ride it, sir. And I was like, howdy. So she flew her to the side and I rode it. Like a few days.
A little warm in the water.
Yeah, like my daughter now, she's 14 now, but she's actually like 19 or 20.
I'm having class.
We finally put us together, and we wrote that same.
Menopause.
Like,
Menopause.
10 years later.
It's real, man. Y'all don't know it.
Right,
You
with
will.
my daughter,
Yes,
you know,
please.
yeah, like, the older I got now, I'm more like.
Oh, really?
I ordered the first time, I didn't feel that.
Yes.
You're right.
He used to tell me,
I guess we can, do you mind if we eat while you talk or?
Please do.
I mean, we should. I don't want.
We're good. We don't want to keep you guys here forever.
So I'll say grace quickly.
Let me stop while you test.
All right. Thank you, God, for getting us all together today, and thank you for this meal, and please help it provide us nourishment and help us to learn a lot from today's conversation. Amen.
Amen. Amen. All right.
Daniel.
All right.
Presente.
So do we just need to open up everything?
Yes.
So we can
Dive in.
Dive in. All right.
We have potato salad.
Sounds great.
Broccoli salad, and then stuff for the sandwich.
Oh, yeah, these are the silverware right here.
Are you
Let me grab
still,
one.
are you like experimenting with vegetarianism or?
Well, Stephen and Danielle are vegan,
Okay.
so we are not vegan, we're vegetarian.
Uh-huh.
We don't really usually cook meat at home, but we have it when we go out.
Okay.
Yeah,
Yeah,
so
we can pop that open.
I guess you could say we're experimenting.
Yeah, yeah.
Yeah, there we go.
I was experimenting.
And we got these.
Uh-huh. Okay.
One of those.
I don't actually put ham.
I'll pass that on.
And
I guess we can pass the bread down. Yeah. You want to put that back on?
that's kind of like.
And then I go just like that.
Because we wanted.
We're gonna do it Thanksgiving style. All right, and then the Thanksgiving table, you know?
Like you said.
Yeah, okay. Yeah. I get a Dukes, and then I'll do, I guess this is in turkey.
Correct.
I think I like that one. Oh, two of
For
them.
now.
He said everything's better.
You sure don't want
No. Oh, I'll go that way too, man. Okay.
Everything is better with bacon is what he said.
Yeah, baby, from heaven,
That's
man.
true.
Ricardo said this veggie burger was better with bacon on it.
Okay, so-
Okay, Nicole, you were holding it last
Yeah,
year.
we did it that way.
Oh, yeah.
And then I'll do this.
Hope
and
you're
I'll do-
hungry, Nicole.
You wanna pop that open there?
I'm always hungry.
I gotta do some lettuce. I don't want any cheese, but I do want some.
I'm gonna eat.
Daniel, what are you? Jose, can you touch that screen to let Michael in? Thank you, just that blue button on the top.
Oh.
Uh-oh. That's okay.
We all right?
Another one here.
Okay, all right, Michael's in the building, I believe. Yep, Michael.
What cheese?
Yeah. Started.
Yeah, we
Hello,
gotta do almost
Michael.
like we were in the Navy. Just say what you eat. Bam. Onion. Yeah, just pass it on around.
Daniel, what are you having for lunch?
A green smoothie.
No worries. I think I'm done. Nice.
Lois is asking to be let in.
Too bad we can't give you any of this food.
Jose,
I'm the gatekeeper.
Jose is the gatekeeper.
Want some
Not, no, what is that?
broccoli.
Okay. Can I get a fork over there? If you have it. Anyone here? I get one.
What are we eating?
Oh, yeah, knife will work too, because I can control. it.
Chick-fil-A.
Oh, somebody dedicate a sandwich to me because that's what I would eat.
And that's what happens when you don't come, bro. You can't eat, man.
I have your sandwich on my plate. man.
You gotta give it to the player.
That's what family's for. Thank you, David.
I'll take one for the team.
Yeah. You know, I'm still.
Napkins. Can I get a few of those napkins?
Yes.
Sure.
Oh, man. If someone can pass the potato salad,
Okay, hold on.
that'd be great.
I need my protein.
Ask Pete.
It smells good. Yeah,
Well,
You
thank
guys
you,
are not eating?
thank you for providing this awesome lunch.
Yes,
Our
thank you.
pleasure.
that's good. Yeah, thank you,
And
man.
dig in, why don't you? I mean, we won't.
Looks amazing.
No, we're gonna go over some mortgage options.
Okay.
Yeah, we'll let us know when you're ready for us to start.
My ears are.
Okay.
Yeah, you can.
Yeah, we're ready.
All
We're ready
right.
when you're ready.
This afternoon now. So good afternoon, everyone. Hello to those online. To mind, I've had the
Good
pleasure
afternoon.
here, but for those online, hopefully in the future, I'll be able to meet you in person. But I'm Stacey King, owner of Premier Coastal Lending. We are also licensed in Colorado. If you ever have someone who wants to leave the beautiful weather here and go be in the snow, we're licensed there. Yeah, the beautiful snow, it is pretty. But you know, they can keep their, what was it, 8 degrees yesterday? And
Wow,
we'll
Lord.
stick with the nice weather.
Yikes.
So this is informal. If you have any questions throughout, don't hesitate to jump in and ask. I'll just cover some information and Sydney, and I'll share a little bit about myself and Sydney as well. So we are partners in business and partners in life. We've been together since 2003. We have 2 beautiful daughters who are 9 and 12 years old, and you know, our lives, I feel like revolve around them. Drop off here, do this, that, but we love it. We're very blessed and grateful. And this is my 23rd year in the mortgage business. Yes, I started when I was in diapers.
Next question.
23 years, and I love it. Wouldn't change anything about the time that I've been able to help people. And I would say, you know, just overall, we're passionate about helping people for what most people is their biggest asset in their life. To us, it's never just a transaction. We treat everyone like their friends and family because we really want it to be an exceptional experience for them. Our business is built 100% on referrals, and we know that, you know, if we take care of people, the rest of it will take care of itself.
That's right.
Sidney, did you want to share?
I have 21 years in the mortgage industry. I started out telemarketing back in the day when we would cold call people. And so one day a loan officer showed me how to set up a loan, and the rest is history. But I love what I do. There's nothing like, when you have a client that's special, it's their first or second or third or fourth or fifth time buying a home, and they get to the closing table and they sign that paperwork and they grab their key. There's nothing like the feeling and the smile that they get when they leave that closing table.
Yeah.
So, we work as a team. You bring us the client, we get them the financing, and we get to the closing table, and the rest is history. So what we're going to present today is just some ideas, some information about how we do what we do, and some loan products that you can use or share with your clients, and go from there.
Okay.
So I want to start by sharing a little bit about history, where we're at, and maybe a little bit of where things are heading. So over the history, and this is going back 4 Fed chairs, everyone hears inflation, right? Rates going up. We expect the Fed funds rate to go up. And the reason the rates are going up and the Fed's fund rate will be going up is in large part because of the inflation. But once the rates go up, what is expected to happen, we have some unknown variables with COVID, now with what's going on with Russia and Ukraine. So, not saying this is exactly what's going to happen, but as inflation goes down, the interest rate should go back down a little bit. That's probably something you haven't heard. All we're hearing is rates going up, right? We started this year off with, they were talking about 3 rate hikes, then it was 5. Now we've heard as high as 7. And they're talking about raising it 50 basis points in March. Well, that's already priced in. The rates have already gone up from where they were. But the reality is, inventory, home prices, rates, none of that is in our control, right? So we have to work with where we're at. And historically, even though rates are, yes, higher than they were even a month ago, 2 months ago, the rates are still amazingly low. I mean, when I got in the business, I was selling rates in the 8s, and I know it was even much higher, further back. So they're still historically low, but I wanted to share the good news that as inflation, when that starts to get under control and that goes down, the rates should in turn go down. And this is what's happened, like I said, 4 Fed chairs back when we had inflation that was being dealt with. So forecast is, that rates for this year were going to be in the low 4s. Generally speaking, depending on a number of variables, we're already there. We do have some, again, depending on the specifics, we have some where it's in the high 3s, but there are some people who now are getting rates in the low 4s.
Okay. Can I ask a question?
Yeah, of course.
So what causes that for some people to go in the 4s? Is it just credit score or what?
It can be a number of variables. It could be credit score, property type, whether it's a primary residence, second home, an investment property. Now recently for high balance loans, and I can explain what that is. Now there's an additional adjuster for those that wasn't there before. So it can be a lot of different variables. But mainly I would say the occupancy of the residence, the score, down payment.
Okay. Thank you.
Of course. Yes.
VA loans, FHA loans, and conventional loans, are their rates normally very similar to each other, or is there one that's typically lower than the others?
Good question. So it depends on, So conventional loans, that's the only 3 types of loans, just to clarify too. Anything else you hear is just a product or a program. Conventional loans are much more so impacted by credit score, as to where with VA and FHA, even with a lower credit score, they could still get a very good interest rate. So I would say VA and FHA are very comparable, as to where with conventional, if the credit score is lower, that rate's definitely going up more.
Is it because the government backs VA and FHA and kind of helps keep the rates down?
Yes. Okay, so and this is information from Mortgage Highway that, they do a lot of research on the housing market and rates and the economy. So I'm just looking at some of my notes here because I don't have that great of a memory anymore. Never recovered from having kids. All right, so.
Oh,
That's what it
There's
is.
more stuff to remember.
Yeah, exactly. So they're saying housing will remain strong in 2022, but not as strong as 2021. I think that personally, I think that depends on the market. I know home prices are going up. Demand may be slightly softer due to a rise in interest rates, but still robust. Supply will increase but remain tight, and that's due to tight labor, supply chain disruptions, and semiconductor shortages. That all plays a role. So the semiconductor shortages, for new construction, for example, you need all the chips for the appliances and this and that now. Rates will continue to go up, but again, once inflation starts to go down, the rates should go down some. I don't think they'll go back down to where they were, but they should go down some is what the prediction is. Okay, so that's just a high level overview of a little bit of history and what's happened in the response to inflation and rates going up and the Fed fund rate and where we're at now rate wise. So I'll pause there. Does anyone have questions?
So you're saying right now, well, what they're saying or what they're predicting, that they might not have enough.
Daniel, Lewis is trying to get in the Zoom. He can't get in.
I think we will have further rate increases. Yes.
Okay.
There will be further rate increases, but for March, I think that's already priced into the market. Because as soon as they started talking about, and it's not if they're going to raise rates in March, it's how much. So they're predicting 50 basis points, so half a point.
Okay.
But as soon as that was in the news, the
Lewis
rates,
is trying to get in.
that often happens.
Tell them to try
where
again. I'm
the
not seeing it.
lender
I'm not
prices
seeing
in
him waiting.
ahead of it actually happening.
Okay. So how many more?
All right, hold on.
I would say 3 to 5. March is the next one, yeah, April.
I know April for sure.
Rate increase.
Well, I have a question. Where does this leave the first-time home buyer who maybe doesn't have the finances of somebody that's paying cash or doing conventional?
So coming from Denver Metro, I don't know if you guys know, we moved to Florida last year. And in Denver Metro, I mean, it's been like it's starting to get here. It's been like that there for at least the last couple of years, where you have people paying $100,000+ over the list price.
Wow.
And so we had to learn pretty quick how to help navigate from the lending side, FHA buyers, VA buyers, even just conventional with a minimum down payment, right? So, and we love helping all buyers, but we love helping VA buyers because my dad is a Navy veteran. His dad was Army. My brothers were Marines.
Always say,
So a lot of it, honestly, I feel like is misconception on behalf of the listing agent. So if I can have a conversation with a listing agent to help overcome myths, or ideas in their mind that they may have that are not right, I have found that that has helped. I've been able to help just from that conversation, help a FHA buyer get under contract, a VA
Right.
buyer, where they think that, oh, you know, we're gonna have to pay all these extra fees, or, you know, there's gonna be all these conditions because of their appraisal. And it's just having the conversation I have found really helps. It doesn't make the deal happen every time, but I can honestly say that it has helped people get under contract. And, or they think like, oh, FHA is a bad loan, or VA is a bad loan, they're not doing any money down. But if I can explain to them, you know, well, they do qualify for conventional, but because interest rates are, whatever the reason is, they can qualify for conventional, but they're choosing to keep more of their money in their pocket for whatever reason. It's not because they have bad credit, or it's not because they don't have money in the bank. It's not because their debt to income ratio is tight, or they can't really qualify for conventional. So just conversations and being honest and helping to overcome misconceptions helps a lot.
Are there any programs for this market that help VA buyers? Because in a resale game, what we're seeing, they're getting outbidded. And even the listing agents are considering them last, those offers last, because they don't bring cash, or they don't bring down payments to the table, or they don't even play the game of going over the price. You know, like a lot of these guys are paying 30 to 50,000 over the asking price just to win the offer. So I'm wondering, is there any programs out there that can kind of level the playing field for the VA buyer?
I would say it's more of just having the conversation and let the lender help have that conversation with the listing agent. We have had VA buyers who have bid over and the property appraised, so they're allowed to do that. VA allows that, so where then they're not having to come in with the 20,000 extra. If there's funds to support that and you think it could appraise for that and they qualify. I know that isn't, you know, an appraisal gap necessarily, but we have had VA buyers do that. But there's not necessarily a special product or program. So VA is such a great option for buyers.
Right.
But they still have that, like you said, so even if the appraisal is, let's say, 5 or 10,000 less than what the offer was, the VA buyer can still just pay that out of their.
They can pay that out of pocket, or if they choose to bid over and it appraises and that's the sales price, then they don't have to bring extra in. But if it doesn't appraise, then yeah.
Would it be beneficial to have, like, for them to be approved? Like you said, it's like they're choosing to do the VA loan versus the conventional, so like to approve them as a conventional. And so when you have like that discussion, you can say, hey, they're approved for this, but they can also, but they're choosing to use the VA because of the benefits versus having to qualify for one or the other.
Yes, definitely. So we like to give them their options of what they can qualify for. And especially if someone qualifies for VA and conventional, or FHA and conventional, educating them on the differences so they can make an informed decision. But then especially if they choose to go the government route, and that can happen where someone qualifies for FHA and conventional, but if they have a lower credit score, the mortgage insurance on conventional could be a lot higher than FHA mortgage insurance. And so they could qualify for more with FHA and get a lower interest rate and a lower monthly payment. But giving them the information and the differences, that's what we like to do. And it can definitely help if they do qualify for conventional, for them and for you guys to know that for when the offers are being made.
Now, that's great what you just said, but I wanted to find out, and I never thought about it like this. If a VA buyer, I'm just trying to find out if the buyer can be stretched. Like if he goes with a certain type of loan, can he get more money versus if he goes with another type of loan? I think you already answered that when you said some FHA buyers their credit score can be lower, but yet they can get a lower interest rate because they're going FHA. But me and Yolanda do a lot of new construction, and I've seen some builders where if you go with their preferred lender, they buy down the rate for them. So that stretches their money, their buying power. And so I'm trying to figure out, do you guys do something like that where you can kind of inform the buyer that it'll be better for you to go FHA versus conventional if you're trying to qualify for this amount of money? Like say they say, in this market, you almost need 450 to probably 600,000 if you want to go in 5-bedroom house that looks decent. I'm just being honest what I'm seeing. And so if they're right on the edge, I got people that right on the edge, and I always ask my lenders, can you stretch them? You know, because it makes the difference. If I gotta show them a $399 versus a $499, it's a big difference in what we're looking at. And so usually if they're low, like anything in the twos, they are unhappy even if I find something, you know. But if you show them something, so that's why I always want to know. So to go back to the question, is there any way to stretch the numbers by different types of loans?
Yes, so we can definitely, there's more stretching room with a government loan
Okay,
in comparison to conventional,
okay,
depending on the credit score especially. But we can, so when we run a loan through, we take a loan application, we upload it to the lender system, and we run automated underwriting. So for conventional, you're not getting an approval, period, no matter what. You can have an 800 credit score, $200,000 in the bank.
right,
You're not getting an approval over a 50% debt to income ratio.
wow,
With a government loan, you can definitely get an approval on a higher debt to income ratio. Even with very little in the bank, lower credit score. So if we need to push it and they're comfortable with that pushed payment, then we can do that.
nice,
But we would make sure, like if it's that type of situation, I'm not comfortable providing you guys with a pre-approval letter unless we've actually run it through automated underwriting to make sure we can get that approval.
gotcha.
Because it will not get approved with underwriting unless we have the automated approval to start with.
Okay.
Cause that helps right there, you know, cause some people think they're locked. As soon as you give them a number, like I have a client, I think it's 269. And I mean, I'm doing everything, but it's for that price. So I was talking to Yolanda just right in saying, single family homes are off the table, man. We gotta look at condo, we gotta rethink this thing, townhouse, because it's just single family.
Like, well,
Yeah, you know,
So,
farm.
but also on that, especially here
Yeah,
in Florida. So when we're going through the process.
thank you all.
all right, thank you.
Nice to meet you.
All right, brother, take care.
So let's say that you have a borrower that, so the amount that they're gonna qualify for is gonna be different on a single family residence than it is gonna be on a condo or townhome, because you have to take into consideration the HOA. And like there's in Fort Lauderdale, the beautiful condo for $169,000, but the HOA was $1,000.
That's right.
So that totally changes the debt to income ratio, right?
Mhm.
So so your clients will probably qualify for a little bit less than they would on a single family. So we have to take that into consideration when
I got
giving the pre-approval. So just keep that in mind, that
Right.
qualifying for a condo may be less than a single family or vice versa.
Let me ask you a question on that. If, say you all have already, because actually you all pre-qualified, for the 269. If he wants to go back in to do the condo, and you had mentioned he needs to do a new application for that.
Oh, no, he doesn't have to do a new application.
Okay, new link,
I just need to, since he's only gonna be looking at condos,
okay,
we need to go back and change the pre-approval or give him the option of what it would be for a condo, because it's gonna be different.
Okay.
okay, but the credit doesn't need to be pulled
No,
again for
no.
that? Okay, good, because he asked that, so
Yeah.
that's why I was wondering. I
No.
said, I'm
So
gonna.
I just have to make the adjustment
Okay,
from a single family to a condo.
okay, okay.
So it could be, it's gonna be different than what we pre-approved him for a home.
Okay, perfect, okay, thank you.
And I did want to touch on the different types of lenders too. So we're mortgage brokers, and you guys probably hear retail lenders, correspondent, mortgage brokers, portfolio lenders, warehouse lenders, commercial, hard money, like there's so many different terms out there. So I'll just give you a quick high level overview of what the difference is. So retail lender, there you could think of banks and credit unions basically, or like if someone calls Rocket directly. So it's they are doing their own lending, but that means it's one set of products and programs, one set of underwriting guidelines, one set of interest rates.
And they're called what again?
Retail lenders.
Retail lender.
Mhm.
Sorry, okay.
So we're a mortgage,
There's least flexibility with those, because
much less
the guidelines are the
flexibility.
guidelines for the one
Right.
company.
Okay.
Exactly. As mortgage brokers, we have access to literally hundreds of different lenders. Like every day, lenders are calling me, probably like lenders are calling you guys every day. So every day, some lenders calling out, telling me what product and program they offer. But that just means we have a big wheelhouse. So of course, we have FHA, VA, conventional, USDA. And I have a really exciting, hot off the press, new option to share with you guys. But we also have your out of the box, non-traditional type stuff. So think of someone like all of us sitting here in this room, self-employed, right? The beauty is you get to write off a lot on your taxes.
Right.
But when you're qualifying for a traditional loan, that lender's going off of the net income.
Right.
Okay, there's some things that could be added back in, so it's not just the net income. But a lot of business owners, you know, their bottom line isn't the reality of their income, but that's what gets used when they're qualifying for a loan. So we have options where instead of going off of tax returns, we can do a non-traditional, still conventional loan. But we go off of bank statement deposits. So we could use the last 12 months bank statements or 24 months bank statements, or we can use a 1099 or a profit and loss. Like we have a lot of different options for that. We also have great options for investors. So not looking at any income documentation at all whatsoever, but instead we go off of the cash flow of the property. So it's based more on the asset and the down payment and the credit score and nothing to do with their income.
That's if it's already tenant occupied,
Doesn't have to be tenant occupied.
That's what I wanted to back up.
so it's just like potential income.
Right, market rent. So we would get a rent schedule.
Mhm.
Also for your Airbnbs and vacation homes, same thing, same program.
Mhm.
They'll go off the last 12 months.
Mhm. Of income generated. Is that from a tax return or from a bank statement, or someone has like an Airbnb? Or some kind of booking schedule or something?
So what they're gonna do is they're gonna pull their market analysis,
Mm.
right? And they're gonna compare it to what you provide,
Mhm.
right? And then like for the Airbnb and vacation homes, they may have a 20% vacancy,
Mhm.
30% vacancy, right?
Mhm.
So they'll have that added in there, but they'll basically, you know, on Airbnb, that's double the income that it would be on a normal rental property, right?
Right.
So that's what they'll base it off of, is they'll do their own appraisal,
Mhm.
they'll base the market analysis off that. Plus they'll include, especially for the Airbnb, being specific on this because I've been asked this a lot from other agents, is because a lot of them don't, this is new.
Mhm.
So they'll ask for the 12 months. So it could be bank statements, it could be from the taxes, however, whatever you're able to provide. A lot of the property management companies will provide, you know, a receipt or a statement, profit and loss or whatever it is, showing the income for that year, right? And they'll base it off that. So, and then if it's just a normal investment property, they're gonna base it off the market.
Mhm.
Okay, Sydney, I want to make sure I'm hearing you right. I'm the buyer. I want to buy an Airbnb for me. So it's going to be income property for me. I don't need to provide I don't have to have reserves or anything? I can.
You will have to have reserves.
Okay.
So depending on where your credit score is,
Okay,
determines it could be 6 months,
Okay,
are 12 months in reserves.
oh, okay. And what do you, when you say reserves, what's the calculation or what are you looking at based on how much of the property costs?
So you can use what's in your bank account,
What's in my bank account?
IRA,
Okay,
401k,
so all of that gathered
all
together,
of that gathered together can count.
okay,
Also, especially, let's say you're taking cash out.
okay, yeah.
The cash out can be used as your reserve.
Oh, really?
Yes.
Mm.
So
You messing with me over there?
You said 6 months, it's the 6 months of housing payment, right?
whatever the new mortgage payment's going to be,
Mhm.
that's what they want.
Plus
6 months.
HOA dues.
Right,
Yeah.
yeah.
Plus
so
HOA,
HOA
okay.
and maybe insurance too, or?
Yeah, taxes, insurance, if there is flood insurance, HOA dues.
So your whole housing
mortgage
expense
insurance.
times 6 months of reserves.
Reserves.
Okay,
That's interesting.
okay.
But now, the question is, still, like say that if cause I've been looking at vacation homes in Claremont, in my area. And some of the older ones, let's say, like I saw one was in good shape, it looked like the pictures looked okay. All right, but let's say it was 400 grand. For that scenario, if I wanted to buy that to use it as an Airbnb, how much can you tell me how much reserves what I need? Is it based on what I pay in my mortgage and all of that, or is it based on what I'm trying to purchase? Is what I'm saying, as far as reserves, how much reserves I need.
So whatever your new mortgage is going to be, based on that loan amount.
On that loan amount, okay,
Because you need 20% to put down.
okay, that's what she writing, why you?
Right, so you need 20%,
Okay,
you still need the 20%,
okay,
okay? But whatever your loan amount, whatever the mortgage payment based on the loan amount is,
right,
The
6,
insurance and all.
6
with all of
months,
that rolled together, 6 months.
everything rolled in, 6 months, 6 to 12 months reserves.
Okay, and now, am I allowed for that income property use VA if I have still eligibility left based on the
Can't
part?
use a VA loan or
Can't-
investment.
Can't use it at all, okay,
Don't. Let me clarify.
okay,
If you took out the loan, let's say you moved to a totally different property,
right,
right? And that's your new primary residence,
right,
and you have a VA loan on your current,
right,
you could still refinance that under a VA loan, and it can be an investment property. But you can't, the loan has to be already in place on the property.
Oh, okay. I got you.
so it's
You
almost
can't
like if
purchase
I move
it.
out of where I'm staying now
Right.
and buy a new property, I can
Right.
use my old property as
You can
Airbnb.
you could refinance your current property,
Okay.
okay?
Mhm,
Under a VA loan,
mhm.
okay? And it'll be, they wouldn't consider it, like another loan, right? Because the VA loan is already in place,
Gotcha, I got you.
okay? So that's the difference.
Okay.
But you can't purchase an investment property under a VA loan.
I got you.
And what we're talking about is the out of the box scenario. Like you
Right.
can still get one with a traditional investment loan if you can, if your tax returns show adequate income. You
Right,
don't have to use this out of the box
right,
scenario.
Correct.
Interest rates will probably be a little bit lower because you're not going out of the box.
right. So if you're doing it the traditional way,
Mhm,
you're still gonna benefit from the low conventional rate.
mhm.
So these scenarios that we were just talking about are what we consider non-traditional,
Right.
conventional loan products.
Okay.
So there's people out there that try to do Airbnb in areas that don't typically allow Airbnb. So when someone's doing a loan and they say, I want to do an Airbnb, I want to use this, will the lender ask for, might need some certain licenses to do that, or do they check?
So it
cross-reference
would have to be approved within the county. So they would have to check with the county and make sure everything else meets.
It's legal.
It's there.
Good question, man, good answer.
I had a friend who just had a home in a regular subdivision, just a regular HOA, and he was using it as an Airbnb for as long as he could until the HOA found out, like, you're not
Right.
supposed to do that. Someone was doing it in Pantherview in our neighborhood.
Yeah.
Someone's doing it on daughters.
Yeah, right across the
Yeah.
street from her. She
Yeah,
kept
right.
seeing
You
new people.
gotta
every week
check the
coming,
HOA.
But nobody's doing anything yet
And
over there.
now
about it.
they are So there are condos, townhomes, apartments that are allowing people to do that. It's just set up a different way.
Something I saw recently was a person was renting a house. He was a tenant. And he was renting the house from someone for like a 3-year lease. And then he was using the house as an Airbnb for other guests.
And so he subleasing. That's what we call subleasing.
Right.
He
so
got a
he-
lease and he giving another one out.
Right, so he's paying $2,000 a month for the house to be his, you know, during that lease period, and then he was using it as an Airbnb, making the Airbnb income
Right.
off of that.
Whatever, what me and Michael were showing somebody a house and that was,
That's it.
in the, whoever was the listing agent had said that was what. they
That's
were
probably where I heard it.
Yeah.
That's
in the-
in that, when you were describing that on the
doing.
huddle or
It
something.
is, but it checked in skate area.
Right, right, so that's another business, you know, there, sometimes when you see these YouTube promos and stuff, where they're like, we'll show you how to make all this money with very little invested. They're coming up with these, you know, unusual.
Well, it's I guess in the neighborhood.
Right.
You said, how do you get, for like a home that's going to be an Airbnb, or a lot of people are looking at it as a possible Airbnb, but it hasn't been rented out as an Airbnb before. And let's just say it does qualify, it's allowed in the community and everything. How do you assess like how much they can get? Or the monthly, like how much
The
monthly
rent,
they can
market
get?
rent.
Yeah.
So an appraiser would do what they would pull up a 1007. So that we do an appraisal, we'd have your normal 1004 appraisal, but they'll also pull a market rent analysis report, which is, they'll include it in the appraisal, it's called a 1007. And so that's what the lender would base their rent income analysis off of.
If it hasn't already.
If it hasn't. But see, here's the problem with that. Okay, there's a catch-22 on that. Because there's no history of the Airbnb income, they're only gonna base it in that scenario on the market rent.
Not real.
That ain't good.
They're only gonna base it off the market rent, because if there's no history, if we can't provide a 12-month history of the double income, you know, that you would get from doing an Airbnb or vacation home, then they're gonna just base it off the normal market analysis, rental analysis.
Long-term rental rate,
Right,
which an appraiser can pull comps
right.
based on homes that have been leased and use those lease prices as comparables, like it would have, you know, it's just an added attachment to the appraisal. And something that a lot of people don't talk about, I've never seen it used, but I know it wouldn't be a thing if someone did not use it out there, and it's probably gonna be more of a thing as interest rates go up, is that VA loans are assumable. So a new buyer can take over the VA loan of the new they have to be VA eligible, right? And then they can take over a VA loan from the seller if the seller had a VA loan. So if they got a VA loan a year ago and the rate was 2.75 and the rates today are 5, for example, then that would make that home more attractive to a VA buyer. And what happens if the loan, the balance is, let's say, only 50% of the value, but the buyer needs more, then can't use that. You can only assume the loan of how it is. You can't say, I'll take that 50% and I'll add another.
Yeah, I'm not sure of that, but with the VA, so conventional loans are never assumable, FHA and VA are. But with VA, if the person assuming the VA loan does not have their own VA eligibility, then that original homeowner's eligibility is tied up in that property. But if the buyer assuming the loan does have their own VA eligibility, then they can use theirs.
Would they go through a lender like you to do an assumption, or they just go to the VA?
Straight to
directly?
whoever that loan is with.
Okay.
Now, my question with that is a listing agent, can we market that and say that this VA loan is assumable so that we could draw VA buyers to that home and get that lower interest rate? So
Right.
we can market that?
Right, yes.
without violating confidentiality of the homeowner, the VA person.
No, it's just an added benefit to the house for a VA buyer.
That's what I'm trying.
Creative market.
Yeah, I know. That's what I heard right away. Like you get a market, a big
My
net.
house has a VA loan. You'd have to pay me like 600,000.
Mine has a VA loan too, man. What are you
I'm
talking
worth that.
And VA loans, VA does not put a loan limit.
Exactly.
So you could do 100% if you have full eligibility,
Right.
100% financing up to a high loan amount. But for conventional loans for Orange County and surrounding areas, the loan limit for 2022 is $647,200. Anything over that is a jumbo loan,
647 what?
2.
Is that a jumbo? Not a VA. It's not a jumbo VA. It's just a.
Yeah, that would just be
For
your
any
standard.
loan at all, like, there's no loans available for more than
Oh,
one?
there are. Good
Okay.
question, Nicole. So this is so exciting. You guys are the first realtors that I know to hear this.
All right.
So this
good.
will also be my daily email. So you'll also have an email with the information. So one of our lenders just this morning came out with, I mean, this blows my mind. On a jumbo loan amounts up to 1.5, you can do 3.5% down.
Wow, that's cool.
No mortgage
No.
insurance.
That's tight. Wow.
So jumbo loan,
Jumbo loan.
3.5% down, up to 1.5, and it's conventional,
3.5
no mortgage insurance,
down.
Yeah, how they doing?
So no PMI.
There we go.
no PMI. It's not quite like the last.
So what they doing
Wow.
is because they're trying to get you to bite off on this hook. It's $1 million or whatever, and it would be worth it. in
Well,
some
I mean,
ways.
areas like in Orange County, there's so many homes that are priced higher and people don't have enough down payment to get it to the conventional loan limit. So this could be a great option for a lot of people. You do need to have a 720 credit score, and the max debt to income ratio is 40%, which is definitely lower than
40%.
Sorry.
most
Say that one more time, I was running my mouth
programs.
to Nicole.
What was that? DTI.
720 credit score
That's
and
720.
only up to a 40% debt to income ratio.
40% debt.
It's only available for a primary residence.
That's still good.
If the loan amount is over 1 million, 2 appraisals would be required. And 24 months reserves are required. So I mean, they're allowing you to do a crazy low down payment,
Right.
but you know, they are restricting a little bit the debt to income ratio. Usually on a jumbo loan, all of our other lenders, it's either the max debt to income ratio is 43 or 45, depending. But this is guaranteed the lowest down payment out there. We have other lenders that do 5%, 10%. But 24 months reserves, using everything Sydney mentioned earlier, brokerage account, retirement account, IRA, checking savings.
And normally, if you do a jumbo with less than 20%, there is mortgage insurance.
No,
It's, the jumbo is considered a non-traditional conventional loan.
Nice. So it doesn't need PMI. I love it. I gotta get some more money.
we all have to support the jumbo deal, right?
I'm telling you, man, we gotta jump on the jumbo.
I've got the credit score, but
I
not
do
the-
too. We do too. We got the credit score, but the other problems. We got some other problems.
Isn't jumbo buyer?
So I'm having the flash.
Yeah, she's having one of those
Sweet.
plain words, private
Some
song.
of the jumbo,
That would make
jumbo
sense if you
home
take out
price to top.
I know.
a line of credit. that can-
Also him, Hela, I think.
they could do that. I mean, if they had a home equity line of credit and they took money from it. So you can take money for either down payment, closing costs, or reserves. The reserves don't have to be liquid, but like if you had equity in a home and you have a home equity line of credit and they wanted to take money to use that to buy another property, that is an acceptable source. Credit card advances are not an acceptable source.
Whoa, back
Has to be
up. You
secured
said, say
funds.
that one more time, because you saying something out. Back it on up.
It's
You
a good
said,
question that brought
Yeah.
it. So if someone has a property already and they have a lot of equity in it,
come on.
they could either do a cash out refinance, or if they have a home equity line of credit, they could take money from that property to then buy another property
Okay.
to cover down payment or closing costs, or if they needed, because you can't just say, I have this property that's worth 500,000, my mortgage is 100, so can you use that 400,000 as reserves? You would have to actually take the money,
So you gotta get it.
yeah, and put it in
See,
your
that's what I
name.
needed to hear. You had to get it. I thought it was
Yeah.
like, you could just leave it there.
Well,
Yeah.
with a line of credit, you could pull it out and put it back in.
Right.
Yeah,
Right.
Yeah,
So,
And it's
after
available
after
to you for like
close.
10 years, right?
Yeah, I think so.
yeah, for home equity line of credit, yeah. Then they
That's interesting.
balloon it.
I don't have that much, so. That's the problem. Not that much.
Do you all do lines of credit, or where would you point?
No,
someone
we'll
to a
do
line of credit?
SIMOs, so if someone's buying a house and they need a first and a second, and
Uh-huh.
for some reason that happens to be the better option for them, we can do that, where it's at the same time, but just a standalone second mortgage, no. Of course, banks and credit unions or online lenders are a good option for a standalone second.
Sweet.
Looks like chocolate chip, one of my favorites.
It's different kinds of.
Is it
So have you
just?
been having buyers that are having trouble getting their offers accepted out there, or realtors that are reporting to
yeah.
you, the buyers are having trouble?
Yeah, it's just, and I know it's competitive here too, but I mean, there it's like a whole nother level of craziness. The inventory is at an all-time low. I mean, there was one property I saw an agent put, there was, I think it was like 250 showings. This is just in one weekend, 78 offers. The house was listed at 495. And 15 of the offers were at 600 or higher. Yeah.
I wonder what it was worth, like, was it listed at its actual value? Or some listing agents are saying, let's list it low and then generate
Get a war.
this unnecessary,
Bidding war.
bidding war. 'Cause you can get a bidding war if you just price it properly, you'll still get one
Yeah.
without letting down 50 people that never had a chance in the first place. And wasting, those buyers' times and those agents' time who were showing it. So that's happening out there. But are you hearing of any strategies in Colorado that have been working since that's been happening there for a long time? Any kind of?
Yes, so one strategy we had, and this was their second home,
Mhm.
right? But, so they're in the range of 400 and 450, right? So what we did was, so some of the offers, so we decided to put both on the pre-approval letter. So we put conventional and FHA. They're approved conventional and FHA, right? Knowing that more than likely, we'd probably end up going in this situation, FHA. But they can qualify both ways, right? And so they finally got an offer accepted, right? It's on a new build.
Oh, nice.
In a really hot area. And the builder allowed them to still use their own lender. And they were able to win that bid on that property. But we decided to, initially we would only put conventional, or if, we were going to go FHA, we just FHA. And we weren't winning those bids, or, the buyer wasn't winning those bids. So I decided to just put both and leave it on there, just so that even if it's listed in the contract that that they're aware of, that they can qualify for both options.
Right.
Okay.
So you disclose that information
Right,
for, I guess, the listing agent and seller,
right.
so they can see.
That they can see.
Get this buyer.
Because sometimes they'll specifically say that,
We want conventional.
especially here, I've had contracts where it specifically say you can only do cash or conventional.
And we see a lot of that.
And, you brought up the VA situation before. But I think, like Stacey said, we need to speak to the listing agent, because there's this misconception that if it's a VA loan, that, there's gonna be repairs that have to be done, certain thing. And that's not always the case.
Very rarely the case.
Very rarely
Very,
the
very
case.
rare,
But
unless it's a really old
You
house
know,
with children.
if you've been in the real estate business for a long time, that's what you're gonna think because
Rumors.
there's rumors,
Yeah.
right? And because I've been part of some of the real estate boards, I know the discussions that we have in these real estate meetings. So, it helps you, for us to talk to the listing agent and say, yeah, they're well qualified. Because the listing agents will ask, well, why are you doing a VA loan? And then I can give them a reason, right? And go from there, right? And it's great because you'll have a lot of listing agents will call me, after I speak with them,
Right.
Hey, you're the only lender that ever called, or
Exactly.
you're the first lender that's called and told me, say hello, right? Because there's not a lot of lenders doing that too.
Right.
And so to me, if they're not a cash buyer,
Right.
that just helps your
I agree.
client.
I think so.
So, because we're building rapport with the listing agent also. And so I think that helps the trend, because they'll call, they'll call to find out what's going on. And, I think that's
Great,
great.
and beat them to it.
Yeah.
Better.
Yeah.
Because I'm able to set up, to keep everybody in loop throughout the process. After it comes out of underwriting, they'll know that it's out of underwriting. And then, when the closing disclosure has gone out and stuff like that. So we're able to keep everyone in the loop, and which is great for the listening because they like to know. I mean, I'm not going to share. We can't share, certain information or specific loan information.
Right.
But if they need to know what type of loan we're doing and why we're doing it a certain way, then I can, I'm able to explain that to them without giving away the
Right.
buyer's personal information.
I think for you two, something that's like in those conversations and those phone calls, I think a lot of stuff as like a listing agent, because I've, for the last few years, I've done more listings. And so I'm on the side of receiving those phone calls sometimes and helping sellers look at these offers from, 10 different buyers with different parameters. You guys as the owners of the business, you call a listing agent and express that this is my personal cell phone number. We own this business. We're not a loan officer. We're not a loan originator. If you need anything or, it's coming right from us. So there's, the buck stops here, just express that from a listing agent's perspective.
That's great.
Yeah.
Because you think of all the other LOs that we've talked to, none of them own the company.
Right. Yeah.
So.
True.
And that gives us a lot more flexibility. So like someone who's a correspondent lender or even a loan officer at a mortgage broker, that mortgage broker or correspondent lender could have their comp set at a certain level and they
Right.
can't really vary from that. We have all the flexibility in the world and we have, because we're the owners, and because we're mortgage brokers, we have wholesale interest rates. So because we're not, and I've worked at a big bank before, I was a manager of a mortgage team, there's not the crazy overhead of paying those managers and the office space. And we can meet people in person, by the way, at an office. And the this and the that, and paying the regional managers and the area managers, there's very little cost that needs to be covered in comparison. So, they'll build in a profit margin into the rate that the customer is paying for. They don't see it. It's not on their closing disclosure, but it's built in and the background. So that does give us a lot of flexibility.
Yeah, because me and Yolanda heard, like when we were dealing with a bunch of different people, they would always talk about overlays. It would be different from company to company. And that's what you're talking about, that they can only go, our company can only go, because I'm always interested to get my clients to buy down. I always talk about buy downs because you can do something about the rate. If you got a buyer and goes, I hate that number, but you can do something about it. And with you guys, it seems like that would be easier than at another company because they have these overlays. It costs more to buy it down here versus over there, people don't like to spend money, especially new buyers when they say, I'm already at the, now I gotta buy down the rate too. So the more you can give people that flexibility and like a different price, that's a win-win.
Yeah, and the mortgage insurance, so because like we work with the #1 wholesale lender and the #1 purchase lender in the country. You know, it's not Rocket Pro, it's not any of the big banks. But because they are the biggest and they only work with mortgage brokers, so we're, you know, only mortgage brokers have access to them, but they're able to negotiate lower PMI rates for our customers than a lot of the competition. And that $20-30, I mean, it may not sound like a lot, but if you have someone who's at the top of their range, I mean, that could make the difference of the house that they want to move forward on.
Yeah, I like that. Yeah, that's great.
And to go back to your question, I mean, we've seen, I know escalation clauses are happening here. So we've seen a lot of that, appraisal gaps, and people waive appraisal gaps out there left and right, like, yeah, we'll just cover anything. They waive all the loan contingencies, any appraisal contingencies. We've seen buyers agree to rent backs for up to a year. So that way it gives that seller time to find a replacement home, so they're not having the pressure, oh, I have to find a house, you know, right away. I sold my house, now I have to find a house. But then that also removes the contingency for when they're making an offer on the next property.
Right. Yes, yep, that, but if a buyer's buying that, they probably they couldn't buy it as a primary home loan because now they have a renter in there for a year, or in that scenario, right? They have to buy as an investment, or?
You know, I had someone do it last year. I mean, I was helping him with the purchase of the new home, but for a conventional loan, you are supposed, for it to be a primary residence, you're supposed to occupy within 60 days.
Wow.
But I know they had a year to find a house, so I don't know what or how the lender, how the
That's what I was
lender, what type of
explaining.
loan it was, but
Was I talking to you about that? This kind of scenario.
I've heard.
Maybe it was Jose on the huddle was saying he had someone and he was running into trouble, and I was thinking the same thing. I'm like, the seller wanted 90 days and the lender required 60 days. And I was thinking, I don't think anyone's going to throw anybody in jail over that extra 30 days.
No, it was Daniel Groucho.
Oh, Daniel
He lost
Betancourt.
a deal because of the difference of 30 days.
Well, he's still trying to work it out. So
But
yes.
is it illegal? Because I don't hear anything that's illegal necessarily. They would know. I don't know if it's a loan rule.
well, so
You know.
if it's, I mean, okay.
There we go.
Fine line here.
We need a lawyer. Which
There are lender rules, and then there's laws. The illegality could be, well, you know, I don't know if it's a criminal act, but falsifying with, you know, kind of withholding information from the lender. I don't think it's a criminal act, or maybe it is, I don't know, but it's, you know, might be hiding.
Yeah, so thank you for saying that. So we said I'm gonna be walking a fine
That's what I
line
was,
here.
I said it for.
Yeah. So, you know, the lender is gonna go off of what they see in the contract, right? So like in Colorado, there's an inspection resolution, inspection objection, but it's a separate document from the contract. And we're like, you know, we don't want that. We don't ask for it. Don't give it to us. Don't open a can of worms. You know, if the underwriter never sees it, then they're not gonna ask for A, B, and C, and D. So, you know, if it's a separate addendum, the rent back terms, then the lender, like, don't tell us about it.
Right.
Exactly. So, and that's what's kind of the preference as the agent. We need to know if that's something that the buyer and the seller is agreeing to. You guys don't need to know that. Is that what you're telling
Well,
me?
we just tried to not open a can of worms. So just like I
Yeah.
think you guys know, we just closed on a duplex and it had an amount with the repairs list. I said, hey, can we, you know, just say the amount of the seller concessions and not specify this and that repair? Because we didn't want to open a can of worms with the lender unnecessarily.
Gotcha.
So, I mean, we'll give you that honest feedback, like,
Yeah.
hey, can we do this or that? Just to try to
No, I
make it
think that's
smooth
smart.
with the lender.
Okay.
Yeah, because. Right.
We don't want to cause any, and we know that it's already hard, and
I know, I get it.
Wes Danny kept that deal together like 5 times. But, you know, we
No,
don't
I
want to
get it.
make it any more tough with more hoops to jump through than necessary.
Yeah.
That's with any loan, like you were saying, the 60 days or whatever for like
Yeah.
FHA or VA. It's supposed to be your primary residence if you're doing a VA loan.
Right.
You can still have like, or 60-day, like legally, I guess,
Your
or
rent
whatever,
back,
60
yeah.
days rent back. But whatever's in the addendum, separately, I guess you can do.
So before, when, you know, I mean, even as a realtor, you would get these buyers sometimes that are like, I want to buy an investment property. Can I just say it's a primary, you know, it's for the lower interest
I
rate?
heard that.
And it's like, no, you know, I just say no, you know, they can find out, you know, when your tax bill is going to a different address and your,
Yeah.
all these bills are going to a different address,
Right.
never going to that address. I just give them that kind of like, it's not so.
It's not clean.
It's not what you expect, it's not worth it. But in this kind of, almost like a gray area where they want the buyer in the house within 60, but the seller wants 90, well, you start looking at that 30 days and, you know, I would almost say, why don't you just agree to a 30-day rent back and then
Extend it.
maybe talk amongst yourselves on the side and say, you know, verbal agreement that if we haven't found a house by then, you'll agree to extend it for us,
Yeah.
or something like that.
Yeah, and you know, in that case, like the first scenario, and that's just straight out mortgage
Right.
occupancy fraud, like, I
Right.
don't want none of that, like, go get
Right,
your loan somewhere
exactly.
else, please. But if it's, you know, the true intention is they are going to occupy that property,
Mhm.
I feel like, you know, that's different.
Right, right.
Now, I just want to ask, because the realtors are in this room, as far as a VA, I was under the understanding if you buy it, you're supposed to be the primary resident, but it's only for a year that you have to live in it legally. After the year, you can lease that home out if you want, you can do whatever you want. That's what, yeah, just 1 year. So even in the scenario that you were bringing up, that might be something that you could tell the buyer. The verbiage is that legally you're supposed to be in this house for 1 year. After that, it's fair game to rent it out, Airbnb it if they allow, whatever you want to do, you know, because that helps you make the deal, because then they can figure out in their mind.
There's a guy that I follow, Julius Gordon. Julius Gordon. That's what he does, or that's how he did his, was he did FHA, where he bought his, lived in it for, at that time, it was a 2-year requirement.
Okay.
And then, you know, he bought another one.
Yep.
And this is what he explains to first-time investors, right? Is, you know, take advantage of the opportunity. If you buy a multi-unit, you can get up to 4 units or a quadruplex, right?
Live in one.
Live in one, rent out the 3. That pays your mortgage, live in it for 2 years.
Do it again.
Do it again.
And we can use the rent from the other units to qualify them.
Yep.
That's sweet.
That is sweet. See?
So
You can
again,
get someone, a first time buyer, to
It's
start
just
doing that
using-
from their first time and then
using
just keep doing it.
loopholes that are there to advance where you want to get.
And to clarify the 12 months, the intention is their intention is supposed to be to live in that property for 12 months. They sign something at
That's right.
closing,
That's right.
12 months. But life happens. We've had plenty of buyers, and FHA is more
Lenient.
specific,
Okay.
not lenient in this
Okay.
particular case, where it has to be like you had a change in your family size or something like that. But I mean, life happens. We've had plenty of times where people, for whatever reason, end up buying a new primary residence in 6 months. And we've been able to get those loans done. It has to be a legitimate, like, makes sense reason, but you know, you can do that. And then the only other thing I wanted to tell you guys before I forget is we also can do up to 10 units and it's not commercial. We can still do it as a residential loan.
Whoa.
That's a non-traditional product,
Okay.
but we can do up to 10 units and it's not commercial loan.
Do you need a different license to do commercial financing?
I don't know.
Well,
Not
not
just like
not as
real estate.
far as I know.
I'm not sure.
Non-commercial loan.
I was gonna say for the VA 1 year, I mean, so if you buy a house and then for whatever they decide to do, like if you're still serving,
Yeah.
you'd have to move anyways.
Anyway, we
We
do it.
rented ours
Right.
out
See, I
for
can't
3
go, my
years
VA
after.
They don't want to hear that.
But that's why earlier when I gave the, because I've worked with veterans who get transferred right? So I have one that was in Colorado.
Right,
He got transferred to North Carolina,
right.
right? He had his current VA loan in Colorado, but he had to purchase a new one in North Carolina. You know, so that's why I said he was still able to refinance that one in Colorado and still purchase his new one in North Carolina. I think we had to set it up where we did the refinance and then did the purchase, but he was still able to do it. And VA was okay with it.
And the refinance in that scenario was for the reserves, just so you have money to go.
No, he just wanted a lower rate, so
Oh, just to lower the rate.
it was just basically a streamline.
Oh, wow. So he lowered the rate on the one that he left. So he wouldn't have both mortgages at a certain amount. He wanted the lower one.
Yeah, so he was gonna rent it out.
Oh, he's gonna rent it out. Okay, so
Right.
that's gonna make him more money.
Yeah, so
I
he
got
lowered
you.
the rate so that, you know, it's more
Right.
rental income.
Profit, profit coming in. I got you.
So that's why I was trying to be very specific on how to do that,
Yeah,
so that VA was aware that he was gonna purchase a home. But that's when I called VA, that's how they told me to set up everything.
oh, nice.
Yeah, so, yeah, I'm gonna check if it's something that's, you know,
Funny, yeah, you
funny,
gonna call.
I'm gonna call because they'll tell me.
Yeah.
You know, I can call and they'll tell me. So,
Let me ask you a question on that with the VA. Does it have to be so many miles away? Do you know if that's one of the, because I've heard that's why I'm asking another.
well, no, I've had people that, let's say, lived in, I'm using this as an example, lived in Apopka and then moved to Windermere or Dr. Phillips, right? That's
Yeah, that's legit. I think they both Orange County, maybe.
right.
In the
But
same-
then we were able to do the purchase.
Wow.
Okay,
Yeah, so it's because it's a new primary residence.
right. So can you use the money from the first home that they're gonna refinance? If they said they're gonna rent it out for $2,000, do you all use that 2,000 as income to go into the new?
No, because
Are you talking about they're gonna rent the house that they have now and you wanna know if they use that rental income to,
Help
Help
with
them
the
get
new
the
one.
second.
yes,
So you can?
you can.
Use that? Okay, I'm asking because my son
Yeah, he
was
had
thinking about that. He lives out in Kissimmee over
Close
by
to
Lake
Lake
Newland.
Newland,
And
almost
he
on the
was
line.
thinking about refinancing his, because he's VA, he used to be in the Coast Guard. He was thinking about doing that, refinancing that home and then put someone in there to rent, but he wanted to move out back to Winter Garden and buy another home using his VA.
so a very important part, another important point about the VA. So as long as he still has
Eligibility?
eligibility,
Right.
they still have to have eligibility.
He does.
As long as they still have eligibility, it shouldn't be a problem.
But what we're trying to get at is the income. Will they count the first mortgage against them?
Yeah,
Because he's trying to say, I don't want that to be my debt to income, because it's gonna turn into now like income property. I'm renting this property, so now my mortgage is being paid and I'm getting, because he's gonna rent it out for more than his mortgage.
we do 75%.
Okay, so that's the answer
Yeah.
we're looking for, like
Yeah.
75%,
Okay.
so not 100. So like, yeah, see, because he wants to get that off, so his debt to income ratio come down, because they're gonna use the new mortgage on the new place to count, you know?
Rent prices are really high right now. So
Yeah, so you can do it.
5% might still cover the
Yeah,
mortgage.
it still might
Yeah.
work, yeah.
Yeah,
Is the heaviest bowl of broccoli.
My wife says it's delicious.
It's
Feels like a
really
bowling
good.
ball. Feel it.
I really love it.
I don't know if this ain't strong enough. Yeah, I got.
But it's good. I'm
I
not sure what's, I know
She
it's
loves
raisin
the
mixed
green
in it,
vegetables,
but
so
it
she
was
said
really
that is
good.
awesome. My wife loves that broccoli, whatever it is.
5 pounds.
So I don't know, I wanted to ask something about,
don't
just
know where the lid is.
what we were talking about, but I'm trying to think of how I want to phrase that. Okay, his original plan, and I'm just gonna ask you, he was gonna do, he has a VA, he was gonna rent that out, and then he was looking for an area where he could use USDA in the new house. Cause he ran it through somebody and they kind of said, man, that's ingenious, you know, how he was structuring it. They said, we don't think, first they said, we don't know, then it came back and said, we could do that. Have you ever seen somebody do that? Went from a VA loan to a USDA loan because you don't have no down payment, no BMI. And
You own
it's
2 homes with almost no money out of pocket.
no out of pocket money, just, my son is like that kind of guy, he kind of think
So
about.
have you heard of that before? Oh, okay.
Okay, but I have to throw a little wrench.
Oh, the wrench, that's why I'm coming, man, I wanna hear the wrench.
So I had a situation like that, right? But
They were selling the current property,
Yeah.
but that was still, yeah, the assets.
But what they were getting back from the property was, I guess, what they were getting back from the property was too much.
Gotcha.
Okay, then also there's income limitations
For USDA.
for USDA. And there's loan limits. So, yeah, it can be done, but you have to just have to watch out.
Yeah,
for
there's
those.
a lot of different restrictions you have to check that you make sure you're
With the
following.
USDA loan, because I will tell you, it was designed specifically for
Certified.
a first-time home buyer.
Okay.
Okay,
Low to moderate income, not
That's what
much
I
in
was saying.
assets, yeah.
right.
That's what USDA was
Designed
designed
for,
for. Was it
yeah.
also designed for someone who plans to work in agricultural or not really?
Yes,
That's what
but again, there's also restrictions and requirements on that.
I.
Because I've had it where people have had farms, but they weren't able to get a USDA loan.
Wow, because it was too high, they made too much.
That or they didn't meet all the requirements. And so I think, to be honest, a USDA loan is a lot harder than a VA and FHA loan.
That's what I've heard. Yeah.
So
It's a great loan option, but yeah, there's more
there's more-
restrictions.
Yeah, there's more to it
Yeah.
than a VA and FHA loan.
And the eligible areas are shrinking.
Oh,
yeah,
yeah,
As
big
of
time.
now,
Here in
like it
Florida.
used to be almost, you could go like Ocoee and West was all USDA, and every time you look, the map just keeps going farther out.
Yeah, they're pushing it out.
I mean, justifiably, I thought it was odd that you can get a townhouse with a USDA loan, but you can, which is odd, because
Yeah.
it just seems like it should be an agricultural property, but.
Yeah, it was meant for rural properties, yeah.
But because it was originally zoned rural in that area where that townhome is probably why it's
Right.
still eligible.
Right, it's eligible, but it almost seemed like that logically they would make that a requirement, like,
Yeah.
you have to have at least a quarter acre maybe. And not a townhouse,
Yeah.
They say no acreage.
yeah, or no HOA at least.
I know.
Maybe a townhouse, as long as you don't have an HOA. Well, thank you.
Thank you guys so much for
yeah.
your time, and you know, if you ever have questions, like, you know, we recently exchanged some text about just general VA questions. If you ever have any general questions, like, hey, what about this, or what about that, or hey, this lender is saying this, is that right, does that make sense? Reach out to us, we're here to be a support and a resource for you, even if we're not doing a deal at that moment, we're here to help in any way that we can.
Appreciate that.
And our cell phone numbers are on our
Stack
cards.
of cards.
Also, I would suggest you follow us on Facebook and Instagram,
Oh, yeah.
because we post a lot of
He's
information.
good with the social media.
We post a lot of information that you can share with your clients if they're on social media. My social
I'ma write it
media, I don't
down.
know if it's on my card.
I don't think it is.
Sydney, okay, Sydney
Uh,
King, what is it?
It's
Okay.
I gotta look
Now you know.
As bad as me.
Sydney, that's underscore that line, right?
Yeah.
Sydney underscore King, underscore my Denver,
All running together, my Denver running together?
yep,
Okay.
MTG,
That's for Instagram.
that's for Instagram, CO.
MTGCO.
Yep,
Got that? MTGCO.
Okay. And
and
that's Instagram?
that's Instagram. And I think I follow everyone on Facebook.
Okay.
Michael, are you still there? Do you have any questions?
I wanna know where the sandwich.
And this is Premier Coastal Lending. Gotcha.
Now, we're my Denver mortgage company in Colorado, Premier Coastal Lending here.
Anyone wants to buy anything in Colorado?
I know.
Second home,
They
get
have
that
you
ski condo.
Can you guys ski?
We're from Colorado, so we're rare people that don't ski. Everyone that moves
No,
there
we
moves there to
ski. Let's
No, I don't ski. I just slide down the mountain.